is it your sense that the market will remain in a supportive frame of mind X of any big policy action, Anand, whether it's on oil or any other parameter? I mean, it's the broad macros that look good, but you're not expecting any specific policy action for a sector?
Well, the only policy action, expected besides the RBI's credit policy, etc., would be the one that we're talking about in terms of oil. Now, frankly, we've already seen the action the market being sensitized to the action by repeated attempts at creating a meeting and then not taking a decision. So I think the market's kind of got attuned to it. So even if there is a price rise, will it react negatively? Not really. I think the market's in a very buoyant mood at the moment. Will that help the macro? Yes, it will. But again, it brings me back to the fear of inflation, because, inflation of 5.5%, which the RBI has targeted in the second half, looks to me now more and more difficult to achieve. And repeated assurances from the finance ministry that the food will cool down inflation, I think is a chimeria, because actually it is not the production which was a problem for the most part. It has been increase in MSP which has been the biggest issue in terms of food inflation. And unless they change the policy on that, which I think is somewhat unlikely, we will continue to see that food inflation remaining high, except for a year-on-year effect. It may not increase this year, so therefore, food prices may not go up. But fuel inflation will happen, and because of that, it will move through the rest of the system. So I think that remains a major worry, but it's not something that the market's looking at immediately.
Infrastructure has started livening up, Anand, after a long time. I mean, for nearly 9 months, these stocks did nothing, and only in the last few days, we've seen some action led by L&T, BHEL, and even some of the smaller construction companies that you spoke about. Would you back that space now?
I think so. Then I think, there seems to be, the more we talk to many of these companies, A, they are full up with orders. 2, the margins seem to be reasonably sustained. 3, there seems to be a change in the way that they perceive the government's attitude towards the business. Just yesterday we were talking to one of the smaller construction companies, and their feedback was that whereas earlier bureaucrats would find reasons to delay projects, today they seem to have targets of their own which they need to meet, and therefore they are pushing the companies to take on more orders than perhaps the companies themselves feel keyed up to do. Which obviously means that at least in the near term, margins can actually go up, because there aren't that many companies which are qualified to bid for some of the business that is coming through. And given that money is easy, there is no particular reason why financial closure for these projects will not happen. And to some extent, that explains the sustained, cement prices, for example. One would have thought that the kind of capacity that's come on, cement prices should have considerably weakened, but except for a few pockets in the country, especially in the south, there hasn't been that much of a weakening in cement prices. So overall, that tells you that construction is here and booming. And, therefore, the fact that the market hasn't paid for it just yet means that there is perhaps some possibility of making money there, especially in the smaller companies, because that's where, as I said, the valuations are not factoring in the fact that the cycle has turned for them, and their order book as well as ability to raise finances is fairly good right now.
The other space in the mid-cap world that you alluded to was consumer. Is it FMCG that you were talking about, or anything which is linked to urban consumption like consumer durables, etc.? Because some of those names have also done pretty well in the last 1 month.
Absolutely. I think FMCG is already well discovered. So at least on the frontline companies, I would hold on to it as a portfolio, but there is not that much bang for the buck that you can get. The alpha plays obviously have to be in the companies which are relatively less owned, and consumer durables especially is one of them. Now, the only problem is there aren't that many plays that you can think of when you look at consumer durables. And that's why we have some very unlikely names been going up. One thing I would caution is that, margins for most of these companies continue to remain very low, and there is no reason to assume that that has changed. Many of these companies, for example, had actually in the electrical space and things like that, or even in the luggage place, had actually started to outsource stuff from China. I think that's one paradigm shift we have to keep in mind, that China is becoming more costly, and relative to us, both because of the currency change as well as the fact that they have now internal labor issues. Honda is a case in point. I believe they've just shut off their facility in China right now for manufacturing. For the first time, we see labor unrest in China leading to increases in wages. So if you have a sustained movement in that regard, where the wage pressure in China goes up, as well as the currency strengthens against the dollar, on a relative basis, we will obviously benefit. So most businesses where we would either import from China have an issue, or for the consumers, or for those who are actually using China as a supply base, they may actually feel the pinch. So, both sides of the coin one need to watch out for, but there will be activities or sectors which will open up, which so far we have not considered. Textiles is a case in point, tires is perhaps another, both of which had import threats from China, which have perhaps to some extent gone away, or at least are reducing.
Any thoughts on two sectors that haven't been loved for very long? The textiles, as you were just pointing out, and what leg specifically, and sugar?
Mitali, sugar I don't really track very closely, so I won't comment on it. Textiles, we've had two positive effects. One, as I mentioned, the China effect, and also therefore a need for diversified international sourcing for many of the US companies. And the other, the fact that there was a huge restocking which led to a very sharp rise in yarn prices. So in spite of cotton going up, yarn prices actually went up even more. So for the first half of this year, we've actually seen yarn doing exceedingly well. So at least, which obviously means that there is a demand even at the end user level for clothes and fabric and so on. How long that will sustain depends largely on US recovery, at least as far as exports are concerned. But on the domestic market, again, we believe that textiles, especially some of the players who are looking at the Indian market, can do quite well, because the consumers is back in the market, and from what we understand, this seems to be the largest or longest marriage season in last 12 years. So you would find wardrobe restocking, as it were, happening in most cases.
So how should investors approach the market now, Anand? Just remain broadly invested, given that the markets, the Indian numbers and macro seem to be in good shape, and then just keep an eye on global markets if things are turning there?
Well, yes. See, the near-term alpha will come from smaller companies. The problem with that is that you cannot really exit that in a hurry. So, at the same time, that's where the big jumps are happening. So you need to stay there if you want to make money out of it. All I'm saying is that there needs to be reasonable caution in terms of how far the market can go and how far many of these companies can go before the next bout of negative news. The negative news is still very much there. It's just that we choose to ignore it. And right now it's not affecting us. So stay invested, yes. I would still recommend that we perhaps give away some of the alpha and stay in some of the larger companies, at least to a large extent of the portfolio. So at least, at a retail level, hold on to a 50-50 kind of asset allocation.
Thanks, Anand, as always, for stopping by with your perspective. That's the BRICS view on the market. They think there is more upside, particularly in the broad